Money management. Understanding the basics of money management. Introduction. Good money management alone isn't going to increase your edge at all. If your system isn't any good, you're still going to lose money, no matter how effective your money management rules are. But if you have an approach that makes money, then money management can make the difference between success and failure. Monroe Trout. Course overview. A firm cannot exist without capital. Without funds, a firm may be forced into bankruptcy, allowing creditors to seize the company's assets. If not the company itself. The lubricant that keeps enterprises functioning smoothly is cash. Many corporate bankruptcies are caused by poor cash management. Companies and individuals overspend their financial requirements and are suddenly unable to meet their business's cash obligations. Cash management is a set of policies and procedures that ensures a company's ability to operate and be prepared for whatever the future may hold. This course will look at how cash moves through a firm, what it's used for, and how to make sure it's there when you need it. Accounts payable, account receivable, budgeting, and other aspects of cash management are covered. Learning objectives. At the end of the lesson, you should be able to define the term cash management. Understand the benefits of effective cash management. Differentiate between the terms cash and cash flow. Understand the concepts of account payable and account receivable. Definition of the term cash management. Cash management is a set of policies and procedures that ensures a company's ability to operate and be prepared for whatever the future may hold. Cash management is also referred to as treasury management. Cash management is crucial for both businesses and individuals since it is a critical component of financial stability. In other words, it is the method by which a company manages its financial activities, including investing capital in various short-term initiatives, collecting revenues, paying expenses, and settling liabilities, all while ensuring that there is enough cash on hand for future usage. Accounts payable, account receivable, budgeting, and other aspects of cash management are covered. The benefits of effective cash management. Cash management is a tool that helps business owners run their companies more efficiently and successfully. Cash management is critical to your company's success. Money management is important because it provides financial security. It allows people to keep track of money. Minimizes stress and conflict. Business growth. Process streamlining. Reduce downtime. Easy access to cash. Cash management's history. Managers were first concerned with liquidity during the Great Depression of the late 1920s and early 1930s. Before this, they focused more on selecting appropriate financing instruments and weighing their impact on capital structure. The catastrophic revenue declines experienced between 1929 and 1933, as well as the subsequent bankruptcy of numerous heavily leveraged enterprises, demonstrated the need for liquidity management. In the 1950s, major advances in cash management were made. During the period from 1950 to the present, several theoretical contributions to cash management occurred simultaneously in a range of domains. These changes took place in 4 areas: cash balances, cash collections, budgeting, and cash planning. Managing cash. Most small and medium firms don't need to deal with cash. However, enterprises that deal directly with the public, such as restaurants, retail, or professional services, do not fall into this category. These companies do have to deal with money regularly. Good cash handling practices are essential to ensure that the actual cash is adequately protected. Cash should never be left unattended or unlocked during the day where unauthorized personnel can readily steal it. A trusted individual should count the starting cash and record it in a protected report at the start of the day. All cash registers should be monitored throughout the day to ensure that they do not have too much cash in them at any given moment. Any extra cash should be counted and stored in a secure location away from the reach of customers. All currency transactions must be documented. Cash and its importance. The term cash refers to funds that can be used to pay bills, purchase services, or purchase goods. The way you pay yourself, your staff, and your taxes is with cash. It's the money in your savings or checking accounts. Cash is also a short-term asset that can be transformed into liquid funds in less than 30 days. Accounts receivable, mature savings bonds, some stocks, or a check are examples of short-term assets that can be converted into cash. Individuals and businesses utilize the cash to pay their debt commitments and operating expenditures, such as taxes, employee wages, inventory purchases, advertising costs, and rentals, among other things. Cash is utilized as a source of investment capital for long-term assets including property, plant and equipment, PPE, and other non-current assets. Excess cash after expenses is frequently used to fund dividend distributions. Cash flow. The net amount of cash and cash equivalents being transferred in and out of a corporation is referred to as cash flow. Inflows are represented by cash, whereas outflows are represented by money spent. The ability of a corporation to generate positive cash flows or, more precisely, to optimize long-term free cash flow, FCF, determines its potential to create value for shareholders. After removing any money spent on capital expenditures, FCF is the cash generated by a firm through its normal business activities. Forecasting cash flows. The process of estimating the flow of cash in and out of a business over a set period is known as cash flow forecasting. An effective cash flow prediction allows businesses to foresee future financial positions, avoid debilitating cash shortages, and maximize profits on any cash surpluses they may have. The balance sheet and income statement can be used to create a cash flow prediction. Tools for managing cash. Cash flow management is much more than merely calculating the amount of money in the bank. Fortunately, there are tools available to assist you in better managing your financial flow. Simple tools can provide a basic prediction that can help you make decisions. They can also have a lot of bells and whistles, such as features that span across departments and into every facet of your business. Here are 5 cash flow management tools that can assist you in gaining control of your finances. Float, Plan Guru, QuickBook, Sorrow, and Pulse. Making a budget. A budget is a written plan that outlines how you want to spend your money each month. A budget assists you in ensuring that you will have sufficient funds each month. You can run out of money before your next payday if you don't have a budget. A budget reveals how much money you earn and how you spend it. A budget shows you how much money you must begin with, how much you expect to have at the end of the term, and how much you expect to have at each stage along the way. A precise budget is an important part of any cash management strategy. What is the best way to create a budget? Make a list of your expenses. Every expense is divided into 2 categories: variable, unanticipated, and fixed, bills. Expenses are the things you pay for with your money. Expenses include the following: bills, mortgage, utility bills. Unanticipated expenses such as food, gas, entertainment, clothing, school supplies, money for the family, and auto repairs or medical bills, as well as credit card debts. Bank reconciliations every month. Your bank will send you a statement for each of your accounts at the end of each month. This statement serves a variety of functions and is an essential component of any good cash management system. The information on all bank statements is the same. They include the account number, account details, the beginning and ending balances for the month, as well as deposits and withdrawals. The first line of defense against fraud is your bank statement. Any unlawful or unrecognized withdrawal should be investigated and reported to your bank. You have certain rights that, if not exercised, will have a significant influence on your culpability for these fraudulent activities. The user will be aided in reconciling the account when using most accounting software. The act of reconciling your account statement with your copy of the transactions is known as reconciliation. In QuickBooks, for example, the user only needs to enter the ending balance, statement date, interest, and fees, followed by marking the cleared transactions. QuickBooks will update the unreconciled amount as the transactions are processed. Account receivable. Accounts receivable refers to a company's overdue bills or the money owed by customers. The term refers to accounts that a company is entitled to get as a result of delivering a product or service. Accounts receivables, often known as receivables, are a type of credit that a firm extends to its customers and typically contain terms that demand payments to be made within a short period. It might be anything from a few days to a whole fiscal or calendar year. Accounts receivables are current assets on the balance sheet. Any sum owing by clients for purchases bought on credit is referred to as account receivable. The consumer has a legal obligation to pay the loan. Companies report accounts receivable as assets on their balance sheets. Furthermore, accounts receivable are current assets, which means the debtor must pay the account balance within a year or less. If a corporation has receivables, it means it has made a credit sale but has not yet received payment from the buyer. In essence, the corporation has accepted a client's short-term IOU. Account payable. A person's or a company's income is matched by their expenses. The money your company owes its vendors for supplying goods or services on credit is referred to as accounts payable. These are typically the short-term debts you owe to your vendors. To put it another way, accounts payable refers to the entire amount you owe to your suppliers or vendors. It's also listed as a current liability on your company's balance sheet. Account payable is due for payment within a year. In addition, your cash flow statement shows whether accounts payable increased or decreased in previous periods. Assume your company's accounts payable grow from the prior period. This indicates that your company buys more things on credit rather than cash. Assume, however, that your accounts payable decrease in comparison to the preceding period. This means you are meeting your short-term responsibilities more quickly. As a result, accounts payable administration is crucial for your company's cash flow management. Credit/debit card. A credit card is a payment card that is issued to users, cardholders, to allow them to pay a merchant for products and services based on their existing debt, that is, promise to the card issuer to pay them for the amounts plus the other agreed charges. The card issuer, typically a bank or credit union, opens a revolving account for the cardholder and extends a line of credit from which the cardholder can borrow money for merchant payments or cash advances. Consumer credit cards and business credit cards are the two types of credit cards available. A debit card, sometimes called a bank card, plastic card, or check card, is a type of payment card that can be used to make transactions instead of cash. It functions similarly to a credit card, but unlike a credit card, the funds for the purchase must be in the cardholder's bank account at the time of purchase, and are transferred straight from that account to the merchant's account to complete the transaction. Cash from other sources. Cash management is a continuous process that ensures the organization is solvent and that the money is put to the best possible use. Businesses are no different than private residences. They will require a cash reserve. The size of the cash reserve is determined by the company's or industry's needs. In some circumstances, the level of the cash reserves necessary is influenced by the company's age. A company must keep a cash reserve to cover a variety of unforeseen expenses such as lawsuits and faulty equipment. Borrowing, owner investments, management activities, and the conversion of other resources are all ways that companies obtain cash. Cash borrowing is done mostly through short-term bank loans and the issuance of long-term notes and bonds. Owners are frequently given shares of common stock as proof of their investments in corporations. Cash earned by management. Management generates cash mostly through customer service. Assets and inventory. Cash management is incomplete without asset and inventory management. Asset management is the process of managing a company's long-term assets. Several criteria go into deciding whether an item should be purchased or leased. A resource with the economic worth that an individual, corporation, or country possesses or controls with the hope of future gain is referred to as an asset. Assets are bought or developed to raise a company's value or benefit its operations, and they are reported on the balance sheet. Whether it's manufacturing equipment or a patent. An asset can be looked at as something that can create cash flow, cut expenses, or increase sales in the future. Inventory, often known as stock, refers to the items and materials that a company keeps on hand intending to resell, produce, or use them. Inventory management is primarily concerned with defining the shape and location of stocked goods. It is required at many points inside a facility or across a supply network to occur before the normal and planned process of production and material stocking. Cash flow statement. The key component of a company's cash flow management is the cash flow statement. The cash flow statement is a comprehensive accounting statement that records all the company's financial inflows and outflows. Cash from operations, cash paid for investing activities, and cash from financing activities are all included. The cash flow statement's bottom line indicates how much cash is easily available for a firm. Investing, financing, and operating operations are the three elements of the cash flow statement. The operating element of cash operations is primarily reliant on net working capital, which is defined as a company's current assets minus current liabilities on the cash flow statement. The statement of cash flows is another name for the cash flow statement. Profit management. Many small business entrepreneurs overlook the importance of earnings. They are content if they are profitable, and that is a negative attitude. You must ensure that the business owners receive profit payments, just as you must have a cash reserve. The most popular technique is to take all the extra cash after a period, usually a quarter, and profit from it. However, there is a flaw with this approach. This strategy does not take into consideration future cash requirements. It also does not set aside funds just for profit. Those funds could be utilized for a low-priority discretionary item while the company waits for the quarter to expire. Profits might be paid out on a monthly, quarterly, or annual basis. If the profit is paid quarterly or monthly, the profit should be held in an accrual account until it is paid. When the profit is paid out, the cash reflecting the profit will be available. Fraud. Fraud is misleading conduct committed with the goal of gaining an illegal advantage for the perpetrator or depriving a victim of a right. Fraudulent conduct can be perpetrated by a single person, a group of people, or a company. There are numerous types of fraud that a corporation must guard against. A company's asset has been stolen under pretenses when it is a victim of fraud. This loss is deducted from the company's profit margin. Internal and external fraud are the two types of fraud. External fraud is the danger of unanticipated financial, material, or reputational loss because of fraudulent behavior by third parties. Internal fraud is a different story. This might range from an employee stealing money from the cash register to asset theft. Concluding remarks. Good cash management is a collection of systems and ongoing actions that ensures a company's financial stability and ability to pay bills, taxes, and employees. Cash management is a difficult topic that is at the heart of any successful organization. Many viable businesses collapse as a result of poor cash management. Similarly, many businesses could be more profitable if they focused more on cash management. A flexible budget is the first step in cash management. Every expense is divided into two categories, variable and fixed. Sales estimates are created based on the budget, as well as expectations for cash reserves and profit. To learn more about our budget management course and similar courses, please visit our school, Bronston Virtual Academy. See the direct link in the description below. Thanks for checking out this course and hope to see you soon.